So I just made a video on cash secured puts, and I wanted to do another quick video on covered calls. So this is when you write contracts on shares that you own, and you need to have at least 100 shares to complete one contract, because for every 100 shares you can write one contract worth of covered calls. So in this case, we are talking about Robinhood. Um, the expiration date is this Friday, so 2 days from now. My promise is I'll sell Hood at 107 this coming Friday, and I received $1.05 per share. So let's hop over to the chart here real quick. So yesterday I noticed that Hood, I got an alert that it hit 104 as this high, and it traded down to just over 100, so like right below 101. And so this morning pre-market, I figured, okay, if it's going to get near 104 again, I'll try to sell some covered calls on some shares that I have. So I decided to do 5 contracts. So that means that's 500 shares worth of Robinhood that I already own. And I had set this price at just over $1, and it hit here earlier today, like towards the end of the day. And so those 500 shares times $104 is about the price that it was whenever the contracts hit, and I was paid $526 for that promise to sell at 107. So $52,000 worth of shares at the time that the contracts went through. So that's a 1% return on those shares over a 3-day period. So if Friday at the end of the day comes and the share prices are below 107, I keep the shares. I always keep the premium, because that transaction has already taken place, and I can sell more calls for the next week or the next month out. Let's see. Yeah, and it looks like on these shares, 101 area is the demand area. So if these things come back down tomorrow or the next day, I can put in a buy order to buy those contracts back at a difference between, I sold them at 105. Maybe I buy them back for, 40 cents or 25 cents or, whatever. It just depends on the price action of Robinhood. So then I keep that difference between the $1.05 per share that I received versus whatever I buy the contracts back at. The next one I sold covered calls on, and this one hasn't really went my way yet, but it's FBTC. That's Fidelity's Bitcoin Trust. So that's Fidelity's ETF that covers the purchase of Bitcoin on your behalf. So with Bitcoin spiking, FBTC here, this green box, that fair value gap, it gapped from $99. The top of the candle looks like it hit 103. And so this box is from about 101 down to $99. And so the price, spiked up here the other day to around 107 and started trading down. And you have a red fair value gap right here, showing like sort of a bearish trend. And it came down and it had a point of interest at 101. And so I had sold the covered calls when this thing was trading at 102. And I thought, well, it may have limited upside because Bitcoin has, basically exploded here from 105 up to the 120 range. So let's fast forward. Okay. So I sold 13 contracts. So that's 1,300 shares worth of FBTC in this covered call transaction. They also expire this coming Friday, so 2 days from today. I sold the $104 strike. Like I said, it was trading at 102 when I had sold these. And so if you look at the red here, it shows I'm negative 49% on the total gain or loss. That's a little misleading. All that really means is I could have made an extra $619 in premium had I waited to sell those same calls, like whenever I took the screenshot. So down here at the bottom, you'll see I received $1,265 for my promise to sell 1,300 shares at 104. And so let's hop over to the chart. So right now it's trading at 104 and 14 cents. So what would obviously be in my favor, what I hope for this to happen is it trades below 104 by the close on Friday and remains in that below 104 even through the after hours session. So then I can keep those shares and then have an opportunity to sell them, next week or whenever I, decide to sell those some more contracts. But if on Friday it's above 104, I will have to sell at 104. So let's say it's 106. I'm obligated to sell at 104, and that would turn out to be a bad trade in general. I will have made, tens of thousands in gains on that trade because I think I own the shares at like $80. So I'd make, $24 per share in gains. But the other thing is I can actually buy myself out of those contracts. So I would wait till closer to the end of day on Friday to see where the price actually is. So I wrote here like what my break-even price is. My break-even is my strike price plus the price per share that I was paid. So if this thing trades above 104.97, that turns out to be a poor trade on my part. But like I said, I can actually buy those contracts back and then keep control of those shares. So I may have to cough up some money, some difference, but if it stays below 104, then I keep all the premium. So anyway, that was another little quick video on how I do covered calls with positions that I have shares in. And thanks for watching.